Yep.
Hello, everyone, and welcome back to the show. Today, I'm so excited to introduce our guest, Justin Kiehne. Justin, thanks so much for being here.
Hey, happy to be here. Appreciate it, Sujata.
Awesome. So everyone, Justin is Vice President of Operations at the Fortitude Investment Group, where he and his team provide investors access to fractional ownership of institutional quality real estate assets, structuring passive, tax-efficient portfolios through 1031 exchange and opportunity zone investments. They claim the single largest DST transaction in the history of the industry at $176 million. Their investment vehicles and strategies are tax deferred and geared towards capital preservation, tangible real estate tax benefits, and the potential for passive income and appreciation. Justin, welcome to the show.
Thank you. And for those folks that are not familiar with the DST, we'll get into that, kind of in specifics as we get into the conversation. But before we start, because I am a financial advisor and it's kind of a highly regulated industry, I would like to kind of knock out some disclosures very quickly, and then we'll get into the good stuff. So this is for informational purposes only, does not constitute individual investment advice, should not be relied upon as tax or legal advice. You'll hear me say that a few times here today. I'm not a CPA, I'm not an attorney. Please consult the appropriate professional regarding your individual circumstance. Investments in real estate may carry risk. DSTs, those are Delaware statutory trusts, are speculative, illiquid, and carry a high degree of risk, including the potential loss of the entire investment. Investors should read the risk section of the PPM for a full disclosure of risks. Potential cash flows, returns, and appreciation are not guaranteed and could be lower than anticipated. Any securities are offered through Concord Investment Services, LLC, member FINRA SIPC, and I am with Fortitude Investment Group. We, Fortitude, are independent of Concord Investment Services. So with the boring stuff out of the way, we can jump right into it. Thanks again for having me, Suja.
Awesome. Well, it's a treat to have you, Justin, and happy to be compliant there. So you guys are obviously experts in 1031 exchanges and opportunity zone investing. Can't wait to dive into that. Why don't you start with telling us the basics for our listeners who aren't familiar with what a 1031 is, what it is, and why it's beneficial?
Yeah, sure. So the 1031 exchange, and the name refers to the section of the Internal Revenue Code, the tax code, right? Section 1031 of the U.S. tax code, and it refers to the process by which an investor, a real estate owner, can sell a property and reinvest the proceeds from the sale of that property into another piece of real estate, while deferring those capital gains taxes that would otherwise be associated with that property sale. And important term to note there is defer, right? We're not eliminating capital gains taxes. We are deferring capital gains taxes. If someone were to perform a 1031 exchange, defer the capital gains taxes today, some years down the line, sell that next property and not perform a 1031 exchange, you will owe all of those deferred capital gains taxes. But the benefit here, right, in not paying taxes today is that you keep all of your money working for you. And in real estate, where we talk about, cap rates, we talk about, a percentage of invested equity, cash on cash returns, things of this nature. A 5% return on $1 million investment is obviously going to be a larger number than a 5% return on $1 million, minus a 23.8 capital gains tax, right? If you're able to keep the full million to reinvest the full million, as opposed to, selling a property for $1 million, paying $200,000+ in capital gains taxes, and then trying to go out and reinvest, the remaining $800,000, you can see how that difference adds up pretty quickly. We see a lot of investors who build wealth through real estate, who own and operate real estate for a long period of time, who use the 1031 exchange as a way to sort of upgrade. They sell one property and they roll the proceeds into maybe a bigger and better property. Allows them to, maybe they own one property for a long time. They pay down much of the debt on that property. They sell that property, they perform a 1031 exchange, and they're able to lever up and buy something larger, going from maybe some residential properties, some Airbnbs, selling a few of those and get into, maybe a multifamily property or retail or industrial, something in the commercial space.
Awesome. Thanks so much for explaining that, Justin. And, we're talking about real estate syndications on this show as part of our focus. How can the 1031 be used with real estate syndications?
Sure. So the 1031 exchange up until 2017, and I guess to take a step back very quickly, 1031 exchange has been around in some form or fashion for about 100 years. The first quote unquote like kind exchange was codified in the 1920s. So this is something that's been around a long time. It's very well established in the U.S. tax code. As I kind of demonstrated, can be very beneficial to folks in terms of keeping their money working for them. 2017 changed the 1031 exchange a little bit. The Tax Cuts and Jobs Act, which was the tax legislation that was introduced, in the first year or so of Trump's administration, and it effectively limited the 1031 exchange to just real estate, right? So previously it was a situation where you could 1031 exchange art, for example. You could 1031 exchange actually. 1031 exchange breeding cattle, sort of a weird thing. You can 1031 exchange, rental cars, planes, things like that. It is now limited to just real estate. And so I get this question a lot where folks ask me, well, I own a piece of real estate through a partnership, it's me and a couple of partners, or I own, interests or shares in a syndication, and my sponsor, performed phenomenally for me. I've been in this thing for a few years. They performed great. We're looking at a liquidation event. As a result, I'm going to have, capital gains taxes to deal with. And right at the end of the day, that's always sort of a champagne problem, better than having a loss, for sure. But I get that question all the time. Well, can I 1031 exchange out of this syndication? And the short answer is no, because most of these syndications are structured as partnerships. And so if you're an investor in a syndication, you are, sort of an owner of an entity. You own a percentage interest or share or unit of the partnership itself. And then the partnership owns the real estate. You cannot 1031 exchange, ownership of a partnership. Okay. The partnership itself could sell the property and do a 1031 exchange at the entity level. But you, the investor, cannot 1031 exchange into or out of a partnership. Now, what we do see occasionally, and I guess before I get away from that, I need to remind everybody, I'm not an attorney and I'm not a CPA. So I'm just kind of speaking to, what I generally run into. You should absolutely, if you run into this situation, feel free to give me a call, but also definitely reach out to your CPA or your legal advisor. And if you don't have the folks, don't feel confident in your CPA's ability to deal with a 1031 exchange, give me a shout. Happy to connect you with, some advisors that we deal with on a regular basis. But what we do see in terms of 1031 exchange into, syndications is a couple different things. So the first that I'll touch on is what's known as the Delaware Statutory Trust. The Delaware Statutory Trust is a fractional ownership vehicle that is viable in the 1031 exchange. It is only suitable for what are known as accredited investors. Accredited investor is defined as $1 million in net worth, not including your primary residence, or meeting some certain income thresholds. It's $300,000 annually if you're filing jointly, $200,000 if you're filing singly. So the Delaware Statutory Trust is codified in Revenue Proceeding 2004-86. For you folks at home that are, sort of like to Google things and do your own research, Google 2004-86 Revenue Proceeding. And it was created as an entity that is viable in the 1031 exchange, does qualify as like-kind real estate, so long as the other rules and regulations of the 1031 exchange are met. But it's essentially fractional ownership. It is akin to, a syndication, and folks are able to sell a property that they own outright, whether it's a, residential rental, for a couple $100,000, or multifamily property for maybe 10 million. They're able to sell that, perform the 1031 exchange, and buy into, reinvest in some of these DSTs. And the DSTs own institutional quality real estate assets. So just sort of hypothetically speaking, sort of generally speaking, a DST might own a $100 million multifamily property, right, in a major market. Or a DST might own a portfolio of self-storage properties. It may own a single industrial, logistics center. It sort of runs the gamut. It's kind of every asset class under the sun. But these DSTs are passive to the investor. You sell your property, which was actively managed, you reinvest, you defer those capital gains taxes, reinvest into, this passively managed investment vehicle that's managed for you by a $1 billion real estate company, right? The sponsor. So that's sort of what we see on the retail side, right? That's sort of what we see as sort of the off the shelf, sort of the off the rack solution. And we do a ton of business in that space on an annual basis. As Sue just said, we did, a single $176 million transaction in that space a few years back for a family out of upstate New York. What we also see in the sort of 1031 exchange into syndication space.
Real quick, Justin. So
Sure.
just so from a syndication perspective, a DST, would it have one member that owns the entire syndication, or would it be
Sure.
a member of the partnership?
Yeah, so DSTs are going to be allowed to have up to 2,000 investors, one less than 2,000 investors, and they are totally passive to the investor. So investors that are buying into a DST, do not have voting rights. The property and all of the decisions around the property are made by the sponsor, but investors do participate in the potential for distribution of net income, of net operating income, and then they do participate in the potential for appreciation on the back end when the DST is sold. And when the property is sold out of the DST, you can then do another 1031 exchange.
Okay, so then are the people who are part of the DST kind of wedded together?
So they are. But they are. This is not your sort of your grandfather's tenant in common structure that you saw that was prevalent in the early 2000s, where you had a smaller number of investors and they all had to agree on any decisions that were to be made. This is a scenario where investors are buying in. They're in the DST, and so they're tied to the property within the DST for the life cycle of the investment, and they're along for the ride, right? For most of the folks that we see that go into these DSTs, the passive nature and the lack of decision-making requirements is a feature, not a bug. For other folks that want to be hands-on, that are kind of control freaks and have been successful that way, the DST is not a solution, and that's fine. This is just kind of one tool in the toolbox or in the tool belt for the real estate investor.
For sure. Okay, awesome.
And then I was going to get into kind of the second way we see folks in a 1031 exchange look to get into kind of the syndication space is through that tenant in common structure, right? So a TIC interest is considered real property. It is viable for the 1031 exchange. Again, I'm not a CPA, not an attorney. Please double check with your CPA or attorney before you make any decisions. But from what we see, the TIC interest is viable in the exchange. And so for some of these smaller sponsors that have a deal, they generally raise capital through sort of a GP LP structure, right? The sponsor is the GP, the capital is the limited partner. If someone comes to that sponsor and says, "Hey, I'm selling my property, I'm performing a 1031 exchange. I like your deal. I like you as an operator. I like your track record. Can I 1031 exchange into your deal?" You have to get a little bit creative, and the specifics of it, are going to be on a case by case basis. It's going to be dependent on kind of what is worked out by legal counsel on both sides. But what we've seen in the past is situations where a 1031 exchanger is able to buy into a deal in a tenant in common structure. And so the exchanger comes in as one of the, the tenant in common owners, and the sponsors, GP-LP partnership entity is the other sort of tenant in common owner. And so you have a partnership and a 1031 exchanger who both own direct real estate. And, in terms of operation of the property, the partnership or the sponsor could have some sort of operating agreement, some sort of, some sort of other documentation in place with that 1031 exchanger to make sure that they are in fact, a passive equity investor. But that is what we see, and that's on the more custom side, and the folks that spend their time doing that, and I know some syndicators in the space that do deals like that occasionally. It's really a kind of a matchmaking process, right? It's more like dating than it is like buying something off the shelf, right? It has to be a match. You have to be sort of in agreement on general strategy, kind of general hold period, and it has to be worth the headache for the sponsor, right? If somebody comes to a sponsor and they're performing a 1031 exchange with maybe $200,000, and the total deal size is 10 million, they'll tell you to go kick rocks, because that's not worth the extra legal fees or the headache to structure this more complicated ownership structure. Now, if you're an exchanger and you come to a sponsor with a couple $1 million, $5 million on a deal size that's 10 million, it starts to become worth their while to kind of make special accommodations. And so that's kind of how I see it on the larger dollar figure, right? In that kind of that custom space, sort of in the referring to that more traditional syndication, investment structure. But again, that's sort of outside our purview. What we focus on primarily is that DST structure, which is, minimums are low, as low as $50,000. We do, like I said, $176 million transaction all the way down to, a condo sale for $60,000, $70,000, $100,000.
Awesome.
I think that you're on mute is like the catchphrase of 2020. Everybody getting used to it.
Yeah, totally. So thanks so much for explaining that, folks. There's obviously so much potential with the 1031. I like how you kind of described it as sort of a matchmaking exercise with the 1031 into syndication, because it's got to be a good partnership. But if you find the right fit with the right deal, the right sponsor, and the right exchanger, then there's a good potential for everyone. So let's talk about qualified opportunity zones and who those kinds of investments might be a good fit for.
Sure. Yeah. So the qualified opportunity zone is a little bit different than the 1031 exchange. So they both offer some capital gains tax deferral benefits, or I suppose the potential for those tax deferral benefits. Qualified opportunity zone legislation was included in that 2017 Tax Cuts and Jobs Act that was passed in Trump's administration, and the goal there was to incentivize private investment in what were deemed underserved, underrepresented, or lower income areas. So there are approximately 8,700 qualified opportunity zones in the U.S., and they're broken down by zip code. Okay, and there were sort of characteristics around what made a qualified opportunity zone, qualified as such. But it was all based on 2010 census data. It was all based on sort of median household income, relative income to, the adjacent metropolitan area, et cetera. As a result, depending on kind of where you are in the country, and depending on sort of how up to date you are on, the nuance and the fun stuff that is tax legislation, you see some of these qualified opportunity zones that are real hellholes, some that are like really, really, poor areas, that are maybe really like industrial areas. And you think to yourself, man, I would never invest my money there. And then alternatively, you see some of these qualified opportunity zones that were maybe lower income in 2008, and based on 2010 census data, they kind of met, that quote unquote lower income requirement. But have since, here we are 11 years later, have since gentrified significantly. And so, governors had a hand in selecting which of the zones that met the characteristic requirements were actually designated as qualified opportunity zones. And so if you're a savvy governor and you're trying to bring, incentivize private investment in your state, you're probably going to identify, pick the OZ, the qualified opportunity zones, that are going to be the most desirable to private investment, right? And so if you have the option between an area that really is downtrodden and an area that has kind of some more potential or is on the up and up, you're probably going to pick the one that's kind of gentrifying. And so we do see some of these areas where you're like, wow, it's amazing that's a qualified opportunity zone. That's a nice area where investment would make sense regardless of the tax benefits. But what are those tax benefits, right? So we talk about the tax benefits as being threefold. There's a D, an R, and an E, right? Easy to remember. It's like Dr. Dre. So the D is the deferral. So if I were to realize a capital gain today, and I were to reinvest.
And just really quick, Justin, because I think this is a really important point, is that, I think of opportunity zone and I think real estate, but as you just told me, it's any capital gain. So can you just can you clarify that for the listeners?
Yeah, sure. So the tax deferral benefits that I'll touch on in kind of a minute here are applied to just capital gain that is invested, right? So if you invest cash into a qualified opportunity zone fund, you're not going to get these tax deferral benefits. But they apply to capital gain of any kind: short-term, long-term, real estate, stock sale, art sale, doesn't matter. Capital gain is capital gain. We had a client who had significant short-term capital gains from trading stock options at the end of 2020, who invested, significant amount of monies into some opportunity zones to mitigate, defer, reduce some of those taxes that would come due otherwise. Important point to note here as well. And I guess that's a very different from the 1031 exchange. 1031 exchange is restricted to real property, which for most folks is real estate, right? 1031 is real estate. Opportunity zone investment is gain of any kind. But important point to note as well, with the 1031 exchange, I say defer. With the qualified opportunity zone, there's a few different incentives. It's deferral, but it's also reduction, and then it's also elimination. So it really is elimination of capital gains taxes. So the first is the deferral. If I realize a capital gain today, I sell stock, I sell real estate, whatever. I realize capital gain, today, June 8th of 2021, and I reinvest that gain within 180 days into one of these qualified opportunity zone funds. The first thing that I get is a deferral. I do not pay taxes on that gain until 2027. It's actually included in your 2026 sort of tax year. And so you would pay taxes on that, April 15 of 2027. So that is the deferral. The second piece is the reduction. As we sit today in 2021, if I were to reinvest my gain in 2021, when I pay those deferred taxes, April 15, 2027, I will pay on a discounted capital gain amount. So I'll pay on a 10% discounted capital gain amount. So if I have $1 million in capital gain today, when I pay those taxes in 2027, it will be on $900,000 in capital gain. So that is the deferral. That is the reduction. Okay, so those are kind of the sweeteners. The big piece of the legislation, and where the folks that are much smarter than me talk about the real benefit, is the elimination. It's the third benefit. So if I invest again, just kind of to keep round numbers. If I invest $1 million in gain today, I don't pay taxes on it until 2027. When I do pay taxes on it, I only pay taxes on 900,000 in gain. If my investment stays in that qualified opportunity zone fund for 10 years, so I invest in 2021 and I keep it in there beyond 2031, any growth on that investment comes back to me tax-free. And I'm going to repeat that. So that is really, I think, the biggest piece of this legislation. So I generate a gain today and I invested in one of these qualified opportunity zone funds, and the fund, meets the regulations, stays invested for 10 years. Any growth or gain that we see on that investment comes back to me totally tax-free. So if, again, nothing's guaranteed, but if it doubles from $1 million to 2 million, that's $1 million in gain on that QOZF investment that's not taxed. If it triples from $1 million to 3 million, that's $2 million in QOZF gain that's not taxed. And that's the really biggest piece of the legislation there.
Yeah, that makes a lot of sense. And thanks for explaining that so clearly. So basically, the way you explained it, there'll still be you'll still pay taxes on 900,000 for 2027, but then any additional gains that are made on the investment, as long as you stay in for 10 years, are free of any sort of capital gains tax. So thanks so much
And what we're seeing, and so what we're actually seeing a lot as well with these funds. So there are a couple of rules. The most significant, I think, or worth mentioning for real estate folks, is that you have to double your basis to meet the QOZF sort of guidelines, which means you can't just buy a building in an opportunity zone and slap some paint on it and call it a fund. You have to double your basis, not including the cost of land. So what we see primarily in these opportunity zone funds is development projects, right? They bought a piece of land and they build on it, or redevelopment. They bought something very cheap that was significant value add, and so they're able to double their basis by redeveloping something into maybe a different asset class, or just a crazy high value add multifamily deal or something like that. As a result, the intention with a lot of these funds and investments is that after a few years, the value of the underlying property or properties should be much higher, is projected to be much higher than it was when purchased. And so we're seeing a lot of these fund sponsors who have a sort of refinance strategy. So you are going to have, you as an investor are going to have a tax bill that comes due in April 2027. And so if the sponsor can create value between now and then do a cash out refinance and make a distribution back to the investor, they now have cash to pay that tax, as opposed to having to come out of pocket, in 2027, when they ultimately do, have to pay, those deferred capital gains taxes. And so there's time value money there, right? Because you've allowed your money to grow over 5 years before you ultimately do have to pay.
Definitely. Yeah. Makes a lot of sense. And thanks for explaining that, other potential way to sort of make it more attractive for our exchange investors. I just think it's so cool that you can use any capital gains, like for so many people whose stock portfolio has gone up over the last, 12 years or so, but want to diversify out of the stock market. It's just such a great opportunity. So thank you so much for explaining that.
No pun intended.
Yeah, seriously. But yeah, so thanks so much for explaining all of that. I mean, clearly there's so much potential there for folks who've been in real estate for a little bit and, want to see what their other options are. Justin, please give the listeners a way to get in touch with you and anything else you'd like to share.
Yeah, sure. So 1031dst.com is going to be our website, or 1031custom.com. Both are great ways. We have a ton of information and educational content around, 1031 exchange, qualified opportunity zone fund, as well as sort of just general real estate investing. Feel free to reach out to me directly as well. I'll give, Suja my email address, my phone number, 410-703-6680. But I'm sure she'll be able to include that kind of in the show notes, or wherever it is that you can find this video. video and the podcast. But it really boils down to, if you have capital gains or you're, thinking about a sale, thinking about a liquidity event, give me a call. There are a number of options we can explore. It's always a conversation. I'm not here to sell you anything. Depending on your scenario, certain strategy might work, different strategy might make sense. It's always very conversational, and we're just here to be a kind of an educational resource. So if you do go to that 1031custom.com website, we have an events page. We're always hosting webinars and things of that nature. And feel free to sign up and learn more.
Awesome. Well, thanks so much, Justin, for coming on and helping us on the ins and outs. Can't wait to try some of this out, and we'll see you again next time.
Absolutely. Thanks, Sujata.